August 1720, London, the Royal Mint. Sir Isaac Newton stands over his ledgers, watching South Sea Company share climb £1,000. A month earlier, he had sold his own stock for a modest profit. Now he watches the price climb without him. He buys back in near the peak. By September, the bubble collapsed. Newton loses roughly £20,000, a fortune worth millions today. He later tells a friend he can calculate the motion of the heavens, but not the madness of men. The smartest scientist in England has just made one of the dumbest trades of his life. This is not an isolated case. 278 years later, in Greenwich, a hedge fund called Long-Term Capital Management builds a trading model so precise that it wins its architect a Nobel Prize. Maren Scholes and Robert Martin, both economics laureate, sit on its board. Their formulas lower down the price risk to a fraction of a percent. For 4 years, the fund makes money like no one else, that Wall Street calls impossible to replicate. Then, in the summer of 1998, Russia defaults on its debt. Market moved in a way the model never predicted. Within the weeks, the fund loses over $4.5 billion. The Federal Reserve has to organize a bailout to stop collapse from spreading through the entire banking system. So the man who wrote the math on risk had just proven they could not manage it. What connects Newton and the Nobel laureates is not lack of intelligence. It's what psychologists call overconfidence. The belief that expertise in one domain transfers automatically to another. Newton understood gravity better than any man alive, which meant he assumed he understood the market too. The scientists at Long-Term Capital had built the formulas that Wall Street itself relied on. It meant they trusted their own models more than the market's one. Intelligence had built a kind of armor, and armor beats carelessness. Because the higher a person's IQ, the more likely they are to believe their judgment cannot fail. There's a second force at work. One behavioral economist called lose aversion. Losing money hurts roughly twice as much as gaining the same amounts feels good. This asymmetry explained why Newton bought back into South Sea stock near its peak. He had already sold one, already banked a smaller gain, and watching others profit without him felt like a lose even though his money was safe. The fear of missing out overpowered the mass he was famous for, which meant the same brain that mapped the orbit of planets could not tolerate the discomfort of sitting still while a market moved. Then there is another player called sunk cost trap. Long-Term Capital's partner did not exit their positions when early sign of trouble appeared. They had spent years building the model, spent their reputations defending it, and abandoning it feels like abandoning themselves. So they doubled down instead. Behavioral researchers have found this pattern in laboratory experiments and in real portfolios alike. The more effort a person had invested in a decision, the harder it becomes to admit the decision was wrong. It's something proof. And also the point is that education does not immunize against this. It can make the trap deeper because educated people are better at constructing reasons to keep going. A third pattern hides underneath both of these: the illusion of control. Highly analytical people are trained to believe that enough research eliminates uncertainty. A software engineer studying in another field, for example real estate cap rates, for 6 months. A physicist recalculating a hedge fund's risk exposure to the fourth decimal. Both share the same unspoken assumption that if the model is precise enough, the outcome becomes predictable. But markets are not physics. They are made of millions of other people, each acting on fear, hope, and information the model does not contain. What nobody in Greenwich accounted for was that other funds watching the same signal would panic and sell at the same moment, turning a survivable lose into a systemic one. Social pressure compounds all of it. Newton did not lose his money in isolation. Members of parliament, friends, and fellow scientists were all buying South Sea shares and boasting about their profit at dinner table across London. They were influencing on what Newton decided. Watching peers grow rich from what looks like the same information created a kind of psychological siege. Behavioral economists call this social proof, the tendency to assume that if enough people believe something, it must be true. And does not matter how high a person's intelligence is if the room around is moving in one direction. The crowd becomes its own kind of evidence, and brilliant minds are not exempt from wanting to belong it. By the time the South Sea bubble fully collapsed in the final month of 1720, thousands of investors across England had been ruined, from tradesmen to members of aristocracy. Parliament launched an investigation. Company directors had their estates seized to repay victims. 2 centuries later, economist John Maynard Keynes studied Newton's private paper and drew a conclusion that behavioral finance would later proven again and again. Newton was not among the fools who bought at the very top out of ignorance. He was among the wise men who understood the danger and still could not resist getting back in. Understanding a risk and resisting it turned out are 2 entirely different skills. The long-term capital management collapse forced a similar reckoning on Wall Street. Regulators tightened rules on leverage. Risk models were rebuilt to account for scenarios the old formula dismissed as statically impossible. But the underlying human pattern was never fixed, because it cannot be. Overconfidence, loose aversion, sunk costs, and social proof are not flaws in educated mind. They are wired into the human brain, including the ones capable of calculating the orbits of planets and pricing the risk of the global banking system. What separates people who build wealth from people who lose it is not always intelligence. It's whether they build systems that protect them from their own certainty, something that Newton never did. See you next time.